A Bitcoin miner just became Anthropic's landlord. $9.1 billion, 20 years, and the stock jumped 20%. Plus 4 more stories moving the AI tape. Let's get into it. Riot Platforms just walked away from Bitcoin's economics and into Anthropic's, signing a 20-year, $9.1 billion lease for 191 megawatts at its Rockdale, Texas campus. The stock surged roughly 20%. 2 5-year extensions would lift total contract value to $16.1 billion, with capacity delivered in phases: 96 AT megawatts in December 2020, another 95 in June 2020. This completes the miner-to-AI landlord conversion trade that's been building all year. Grid-connected power, not silicon, is now the scarce asset being securitized on 20-year terms, and Anthropic has signed 3 compute commitments in roughly 8 days. The bear case: Riot is trading uncapped Bitcoin upside for fixed rent, and the first dollar of revenue doesn't arrive until December 2020. 18 months of construction risk first. If Anthropic signs a 4th deal before month-end, expect more miners to reprice as power landlords. If Rockdale's first phase slips, the entire conversion trade takes a haircut. Sony just handed TSMC the one thing it never had to share. Sony Semiconductor Solutions and TSMC agreed to form Advanced Vision Semiconductor Manufacturing Corp., a 747 billion yen joint venture, about $4.7 billion, building next-generation smartphone image sensors in Kumamoto, with volume production targeted for 2029. Sony invests $2.92 billion and remains controlling shareholder, contributing cash plus its newly built Kumamoto fab. TSMC puts in 282 billion yen and the advanced process. Sony has owned CMOS image sensors outright for a decade. Conceding the logic layer says leading-edge nodes have gotten too expensive to self-fund, the same capital gravity that pulled Apple and NVIDIA into TSMC's orbit. The bear case: Sony keeps design, but loses process independence permanently. Capital contributions are phased against market demand, which means watch Sony's next CapEx guidance. If sensor CapEx falls, the outsourcing is structural, not tactical. Bond buyers wanted Alphabet's paper. Shareholders wanted out. Alphabet completed a $25 billion multi-tranche note offering with maturities running out to 2066, drawing roughly $115 billion of peak demand, one of the year's largest books for AI-related debt. The stock fell 3.61% the same session. Here's why. Alphabet posted a negative $5.9 billion free cash flow quarter, its first ever, as quarterly CapEx roughly doubled to about $44.9 billion, with full-year guidance raised to $195 to $205 billion. 40-year maturities mean Alphabet is terming out AI infrastructure like a utility, not a software company. The bear case: equity holders now absorb build-out risk that credit markets priced cheaply, and the DeepMind leadership changes remain an overhang. If next quarter's free cash flow stays negative with CapEx guidance intact, expect the multiple to compress further. NVIDIA is now financing the customers. Wall Street's balance sheet math won't. It signed agreements with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to stand up independent platforms, mobilizing more than $500 billion of third-party capital for AI infrastructure. Jensen Huang told CNBC he approached exactly 6 firms, and none turned him down, pitching GPUs as a financeable asset class rather than a CapEx line item. Connect that to Alphabet. When a hyperscaler's free cash flow goes negative, funding its own build-out, private credit is where the next trillion comes from. Morgan Stanley estimates roughly $3.5 trillion in hyperscaler spend through 2028. The bear case: this is vendor financing at industrial scale, NVIDIA arranging its own demand, and the market noticed, with the stock giving up its Monday gain to close near flat. If the first platform price is at wide spreads, the circular financing critique gets real teeth. OpenAI is thinning its safety bench exactly as Congress reaches for the subpoena. Reporting originating with the Financial Times surfaced Tuesday that Chloe Bacalar, OpenAI's only dedicated ethicist, left in July after less than a year, and the company has no plans to fill the role. It was never announced. She joined in August 2025 from Meta, where she was chief ethicist for nearly 4 years, and her exit clusters with the departures of Johannes Heidecke, who ran safety systems, and Joshua Akiem, the chief futurist. This lands the same week House Democrats demanded AI chief executives testify over rogue model incidents. The bear case for investors isn't ethics, it's regulatory beta. An empty ethics seat is the easiest thing for a hostile committee to hold up. Watch the hearing calendar. If OpenAI is named in a testimony request with no safety executive to send, that overhang follows the company into its next raise. One through line today. The AI build-out is no longer funded out of cash flow. Riot's 20-year lease, Alphabet's 40-year bonds, and NVIDIA's $500 billion private credit machine are the same trade. Power and silicon financed like infrastructure. Subscribe for tomorrow's briefing. This is the Daily Alpha.